Hi there, this is Alvin from Dr. Wealth. The US stock market is not short of negative news. We have seen inflation, we have seen recession fears, and now recently we have this US credit worthiness downgrade. So, what happened was that in the few days ago, the Moody's, one of the rating companies in the US, have downgraded the US credit rating, not from the top now to the second level, right? It's still investment grade, and this is not the first time that credit rating has downgraded the US ratings. We have seen the first time was by S&P, and that was in 2011, and Fitch did it in 2023. And now Moody's is just following the footsteps of the other two rating agencies. So what's going on? What is the big deal now, and why is it causing the share price to have some reaction? Right. So let's dive in deeper because this is just the surface of the underlying issues that the US is facing. And the other trigger that's also going on is the Trump's tax bill, right? And they want to cut taxes, and that will affect the revenue of the US government, right? They will receive less revenue at the end of the day. And it was estimated to be adding about $3 trillion worth of deficit over several years. Okay, so these are the things that have happened in the past few days, and that caused one of the biggest impact was the bond market, of course. We have seen the US 20-year treasuries rising to 5.1% yield, and that is almost a 20-year high, right? So there was another issue was the bond auction. There was some concerns where the demand was not high enough, right? So it's a whole package thing, right? If the yield start to go up, it's usually because the credit worthiness is not that high, right? Because if it is risky to lend money to someone, you will demand higher interest to compensate for the risk that you are taking. And naturally, the demand will be lower, and you need to increase the yield in order to attract more investors to come in. So that is why the yield is climbing. And bond price and bond yield move in opposite direction, right? So if the bond yield are going up, that means that the bond prices are falling. And there is an ETF that tracks the 20-year treasury bond that is the ticker TLT, and it's down 4% year to date. And yesterday it was down more than 1% in one day. And in the past 5 years, more shockingly, it was down 50%. And mind you, this is a investment grade bond and one of the safe havens in the world. And you are seeing this kind of a massive drop in the prices, right? So just also take note that this does not include the interest as received, right? So this is purely based on cap gains and cap losses. And it also spilled on to, of course, the rest of the asset classes, right? We saw S&P 500 down almost 2% yesterday, and the US dollar has also weakened, right? Because again, if there's less demand for US assets, such as the US treasuries, that means that the demand for US dollar is also going down. And what is really hanging on for the entire US economy is US dollar is still the reserve currency of the world, right? And that's a very important status that the US cannot lose if it is going to continue to be the biggest and the most important economy in the world. And of course, when US dollar weakens, the alternative store of value like gold has went up 0.74% yesterday, and Bitcoin has also went up and in fact break a record high, reaching more than $110,000 per Bitcoin yesterday. So what is driving all this? And we all know it is not new news because the physical debt has been climbing and it has not seen any reduction over the past 5 years at least, right? Or even the last 10, 20 years. Okay, it has been climbing and climbing. And initially, there was some hope that DOGE or DOGE, Department of Government Efficiency, which was headed by Elon Musk, is brought in to reduce the government deficit, right? So Dodge claims to have saved $160 billion through initiatives, but the calculation was closer to 9.6 billion. And in fact, the even if they count 160 billion, it is just a fraction of the US debt, which is standing at $36 trillion. It's just about 0.5% savings. So it wasn't enough to move the needle. And on the contrary, Dodge itself had incurred even more costs, $135 billion, due to the disruptions, due to all the severance packages, drop in tax revenues, right? So all this, if you add together, would probably even amount to $500 billion worth of loss, right? So that is the issue, that this dodge did not really work out. This solution doesn't work at all. And to add problems to the existing issues, we also have seen that the interest payment has been rising due to high interest rates. And now the interest rates that is paid out in the past quarter is higher than the defense spending. Okay, so this is not really something that is sustainable, right? And what's worse is that there are about a third of the US treasuries maturing within the next 1 year. And that means that they need to issue at higher interest rates again, right? Because now U has gone up, credit worthiness have gone down. And the worst is that less buyer also means that the U can continue to go up even more. So who are going to buy these bonds, right? So it is the Fed going to print more money to buy the bonds, right, to lower the interest rates. So we don't know yet, okay, whether they are pressured to do that. So Buffett also said in a recent AGM that this physical deficit that the US is running is not sustainable. He doesn't know what will happen. He doesn't know the degree of the impact of the problem, but he just know that it's unsustainable. At one point, it's going to break. Okay, so this is the problem, the debt issue that is getting more and more pressing as the day goes by. At this point, probably, I think that over the past several years, we are starting to really see the treasuries reacting negatively to this physical deficit, right? So this is a important slide, right? This is to describe what is going on in the US economy. And it is a downward spiral, right? Because for the US, it's a very huge consumer economy, right? A lot of things are produced outside of the US, right? That's hence the trade deficit that Trump is trying to correct. So US consumes a lot, and the money flows out of the US. And in order to support the consumption, US have to borrow money, and the government sells treasuries, and naturally it becomes indebted because of all these bond issuance. So foreign countries will buy these US assets because they make money in US dollar by selling goods to US. And when they buy these US assets, the US asset prices go up, and it benefit people with capital, right? Even the Americans. Okay, so as long as you are invested in the, say, the US stock market, for example, you will have made considerable increase in your net worth over the last 10 over years, right? So it's have been the best performing stock market, okay, and therefore more people were enticed to invest even more into US assets. Okay, so all is good at this point in time. But of course, there's always a segment of the market or the economy that some people are less off or worse off. So, for example, the blue collar workers that get outsourced to the rest of the world, they would continue to suffer from low income, right? They may not be able to increase their spending because their income is limited. And with inflation, they will get hurt even more. So that naturally balloons because of all these borrowings, right? And this is where we are now, right? US credit worthiness drops. And we also see less demand for US Treasury that happened in the auction, the most recent auction. And it is possible that eventually someone has to buy it, and also to curtail the interest rate from rising, at least the long-term rates. So where is the money going to come from, right? So printing money is one of the solutions, unfortunately, and that would lower the short-term interest rate. But that may not lower the long-term interest rates, because long-term rates is not controlled by the Federal Reserve. The Federal Reserve only control the short-term rates, okay, up to a year. So the long-term interest rate may continue to rise if the creditworthiness or the impression or the perception of US debt is not something that is safe anymore, right? So that would increase the interest rate further, and the debt would be even more expensive. Yet the US cannot stop borrowing, and that will fuel further deficits. Okay, and eventually come to a day where the demand for US dollar depreciates, the US dollar demand lowers, and that means that the challenge to USD as a reserve currency happens, and if you lose the status, it will be a very detrimental scenario to the US economy, right? So likely the currency will have to depreciate even if the USD continue to be a reserve currency, right? So that is almost like a confirmed thing. It's just how much it depreciates, okay? And goods may even become more expensive, right? Because US is a consumption economy, they continue to buy stuff, If the US dollar get weaker and weaker, which means that the imports will get more and more expensive, and that would fuel inflation, and short-term rates could not be hiked because the Fed probably need to print money to keep the to buy the treasuries, right? So that would keep the short-term rates low, and you might have an issue with inflation again. So there could be many scenarios, right? This is just one of the overview of what could happen and what is actually happening to some degree in US already, right? So it is not a simple problem. It's definitely beyond our pay grade to solve this issue, right? But of course, it needs a lot of political will and a lot of the short-term sacrifice that the US need to make if they really are serious about reining in this debt problem that they are facing. But with all this trouble, some of you must be thinking that should we just avoid the US market altogether? Is this the end of the US exceptionalism? The past 10 over years of a strong bull run in the US stock market, is it the end? Is it over? And especially if you look at the international stocks, right, outside of the US, Europe has been doing well, Asia has been resilient this year. Getting gains beyond the US market seems a lot easier this year compared to previous years. So is this the change of fortune that we are going to be looking at in the near future? We won't know exactly what will happen, but my view is that it's too early to bet against America, right? Even Buffett, okay, during the COVID period, already people were talking about US exceptionalism is over, all these kind of things, right? And he also reiterated never bet against America. And he walks the talk because he is not selling any of the US equities, right? He does sell quite a lot of bank stocks and he does raise a lot of cash, but majority of his investments are still in US and just a bit in Japan, right? And that's it. Okay, main part of his investment is still in the US. If he is thinking that US is uninvestable, he would have liquidated, but he didn't. And it is unlikely that Great Apple, the successor, is going to change that direction anytime soon, right? So don't bet against America. It's not a time, and it's still home to the best companies. Remains a talent magnet. It is still the reserve currency. It is still a land of innovation. So my view is that even if the power, right, of US is declining or waning, the leadership is still unlikely to change in the next 10 years. Okay, so there's still quite a long runway for a lot of investors to look at. Of course, one thing to be concerned about with regards to the stock market is that the S&P 500 does look overvalued. Okay, if you look at based on the PE ranges, it's at around +1 standard deviation. It went down below +1 during the trade war, but then when the trade tariffs were suspended for 90 days, the S&P 500 has rebounded and regained the losses. So now we are back to around +1 standard deviation in terms of the PE range, and that signifies that the S&P 500 is overvalued. Okay, it's not cheap at all. But that said, we believe that, or we even see that there are some undervalued opportunities. Okay, so this is where picking some stocks that are undervalued will make sense, right? Rather than buying the entire market, which looks overvalued. So there are opportunities, right? Not a time to just shun away from the market altogether, right? US stock market is still a very important asset in the investor's portfolio, right? So it is usual that the stock market climb a wall of worry. It's always the case, right? There's always something to worry about, right? But if you react to every worry, it will be detrimental to your long-term investment results, right? So I hope that you are clear about the situation. It's not an easy problem to solve, right? But I do think that this worry is a temporary impact to the stock market. If we zoom out, it should be fine for many years to come. All right. Thanks for watching. Remember to give me a thumbs up, subscribe to the channel, and I'll see you in the next one. Goodbye.